So I know that it's very close to lunchtime, okay, and this session is going to be very interesting and extremely relevant for all of us. I would say that with the recent changes and amendments and all the developments that are happening on the GST front, uh, any CFO summit would be incomplete without having one session on GST, right? And that's why, we have arranged this session. What we want to achieve out of this is that, we don't want to take you through all the recent amendments and budget, because I'm sure all of you would have already attended quite a few of those in the last 1.5 month. Uh, but what we want to really achieve out of this is to acknowledge, understand, and identify the key industry issues and pain points for the retail sector. What are, we'll hear first-hand experiences and responses, feedbacks from all our distinguished panelists, CFOs, and of course, Vivek is there, who will bring in the angle of litigation also from a lawyer's advocate's perspective. So end of the day, what we want to come out with is certain pointers which we can take to the government in terms of advocacy or representation areas, and discuss all the pain points. So that's a quick introduction from my side on what just to set the context here. Okay. The GST collection, as you all know, has been booming since last 1 year, 1.5 year post-COVID, and we have already breached the mark of 2 lakh crore per month. Even now, the latest monthly collection is almost 1.8 lakhs plus for the month of July. And you won't be, we all won't be surprised if you see a jump in this in August and September, because all of you would be knowing that the GST assessment and notices are right now coming in full swing. There is a flurry of notices. In fact, as we speak, there are many officers who are already drafting the orders for 2019-20, and you will get a love letter on your email sooner or later on the assessment orders. And that brings us to the most important point, that in terms of tackling the GST litigation and what are the issues that the tax officers are picking up today, what precaution should we take, right, as companies, as CFOs, in terms of planning and preparation? So that's what we want to achieve, right? And with that, maybe I'll start with the questions. So the first question that we thought was most relevant and we can start off with was on retail companies, or the retail store companies, and this question is to Jayesh. So basically, retail companies end up opening a lot of stores, closing some, renovating existing stores on an ongoing basis, right? And this is a regular activity. This is not a one-time activity. And GST is a significant cost on this, right? And I'm sure we would have already seen notices and litigations happening on this front when it comes to GST input tax credit on various items or various costs that are incurred, right? Today, I understand most companies have a model wherein there is a local developer whom we nominate to do the civil construction part of it, but the fit outs or the items or the capital goods, plant and machinery, air conditioners, which are required in the store, are per se purchased by us, either directly from the vendor or in some cases there is a works contractor. So the question, Jayesh, was that what is your take on this as far as the GST law is concerned? Because there are a lot of restrictions on input tax credit, and there are a lot of challenges in convincing the tax officer on input tax credit eligibility.
Yeah, for the GST point of view, there are many civil contracts, and you do a civil construction works, etc., for the setup of the new stores. For setting up the new store, you have to capitalize in the books of accounts, and if you capitalize the books of account, the input is not allowed. basic objective of the GST was no cascading effects, yani tax on tax should not be levied. Then everything should be allowed to be set off against, if one tax is paid, that should be allowed, like service tax, rental you pay the tax, can be against, set off against the any finished goods, sales, etc., etc. So no cascading effect. But if you don't allow the input, then your burden of the, ultimately your cost will increase. Once the cost is increased, you have to pass on to the customers, your margin will reduce, your cash flow requirement will increase. Or beside this, there are the issues like, because in a civil construction contracts, there are things like, there are certain, if you capitalize this, input is not allowed. If you expense out, the input is allowed. What to capitalize and what to not to capitalize. Like there are certain stores, you do a renovation also. So in a renovation, if you expense out, the department comes and asks you, why you had expense out? They go into that case, we are following the accounting standard, and as per the accounting standard, we have to expense out. When they come, if there is a major expense, they will ask you why you have, just to claim the input you had expense out. So there are the litigations coming from the department. Besides this litigation, there are like certain like lift. If you install the lift, they say it is a immovable civil construction contracts. If you install escalators, HVACs, even there are certain times the fittings, the wirings, etc., electrical fittings, they say, okay, this is not allowed. And actually, as per us, it is movable. We can remove it and install it in other stores. The civil can be like tiles, paintings, false ceilings, etc., which I cannot remove it. But department always take a stand that hey, this is not removable, it is fixed to the earth, the input is not allowed, and this all increase the litigation in the, and there is a dispute, then you have to go to the appeals, etc., etc. So department has to come up with the clarification, say that okay, these are the things like HVAC, lift, etc. should be allowed. I went, because when we represented RIA in 2017 and met the officer that time, I went at one more step ahead, asking everything is to be fungible. Why one state input lying in the one state is not to be allowed to be set off, not to be transferred to another states? Everything is to be, you say that everything is allowed, the input is lying in your account, then you are allowed to set off. Then why I cannot transfer to another states? If I close down the stores, yes, point out the point that if you close down the store in a particular store or particular states, what you will do for that inputs? You will not be able to utilize that inputs. So we have already approached many times, multiple times the department, but department is not, but we are still trying that everything should be fungible, everything is allowed to be set off against each and everything.
Yeah. So very well put up, Jayesh bhai. I think two takeaways for all of us. One is that when we we do the entire planning of the capex acquisition for any new store or renovation of an existing store or even closing of a store, we need to take care of certain aspects in terms of budgeting and also contract structuring. For example, I mean, just an illustration is that, let's say we want to set up a new store and we give the entire contract to one single party who's a EPC contractor. And we give him an instruction that you do everything at your end and we will pay you a lump sum price. This is how invariably it happens. What happens is that we might be buying furniture, we might be buying air conditioners, we might be buying movable items on which otherwise you are eligible for GST credit. But because you have put a party in between who is a works contractor, he will raise an invoice on you as a works contract service. Okay. And then this will give an opportunity to the GST authorities to deny the entire GST credit. So first aspect is to look at it from a planning perspective, contract structuring, to optimize your GST cost. That's one. The second takeaway for us is that there is an advocacy opportunity here. I mean, this is the genuine issue of the entire industry because it's a significant cost. 18% on your capital cost is not a joke. So we need to optimize this. If I compare retail industry with a typical manufacturing company, a manufacturing company is primarily eligible for plant and machinery, all movable items, even the foundations of plant and machinery are eligible because that is treated as good as plant and machinery. But for the retail industry, what is the main asset? The main asset is the store. And if you are not eligible for credit on that, that is a disadvantage. And eventually it adds up to the overall cost and it makes us less competitive in the market as far as our products are concerned. So this is food for thought. I mean, one clear representation area on this. Okay, we move on to the second question. And maybe this is a joint question for both Kaushal and Manish. And the topic is inverted rate. And I'll request Kaushal to start off on this. And then Manish, you can also share your insight.
Sure.
This is a issue which we are talking about where your product is under a lower rate of GST, could be 5 or 12. For example, footwear, certain leather articles, okay, apparels, so on and so forth. While on the input side, you pay GST on a much higher rate, 18% typically on the services, various types of expenses that you incur for running the business. And there is a refund mechanism in the GST law, but it is only covering inputs or goods. You don't get GST refund on the input services. And even on this, there has been litigation, representation, but till now, there has been no success on this. So, Kaushal, you can go first on this to share your perspective and your experience.
Sanket, for sure, this is the second point for representation, even before I start answering this question. Let me speak from the footwear industry point of view. First from MBL, that's Metro Brands Limited. Fortunately for us, most of our input comes at 12% and our output is at 18%. So fortunately, we don't face the issue. But if I talk about larger in the interest of the entire industry, I talk about footwear industry as such, our vendors, they pay 18% on most of the raw materials that they use for manufacturing of the footwear. And when they sell, the output is at 12% if the selling price is below 1,000. And this get accentuated, because obviously on your base product, there is an input that is getting accumulated, and then you incur all the costs on which you still pay GST, and most of it is at 18%. Now, with them, where the profit margins are thin, anywhere between 5 to 20%, it becomes a huge cost. And just think this from an overall perspective, right? You're using your funds are blocked. Eventually, this will get built into whatever cost that they bill to us or to the next person in the ecosystem, and then it ultimately goes on and gets charged to the customer in the overall price. So yeah, this is a very widespread issue. As we all know, government is looking at this. I think the most ideal way to tackle this would be to review GST on the raw materials and input. If that could be rationalized and brought, and if those are aligned to the output GST rate, I think this issue can be taken care of. And eventually, if this is done over a period of time, it may lead to softer MRPs from a customer point of view, right? So I think that would be the best way forward. Till then, I think government should look at allowing refunds even on the input service part, because otherwise it's a blocked amount where you don't know how are you going to utilize it.
Absolutely. Yeah, Manish.
See, apparel and textile industries are poised to the inverted duty structure, wherein in both the cases, one is the fabric part, which is the finished supply, and majority of the raw materials input services are taxed at 12 or 18%. And once the final product fabric is taxed at 5%, this leads to a problem of blocking of working capital and the ITC accumulation, which cannot be utilized at any of the state. Irrespective, government has come up with the refund mechanism on inverted duty structure. In August 2022, there is one notification or circular mandating guidelines to get the refunds. We have also applied the refunds, but in some of the states, government is, department is not allowing the refunds, and see, we have to file an appeal. This will lead to the further litigations, but once council will correct the inverted duty on the raw material or majority of the dyes and chemicals which are used in textile or apparel industry, that will only correct the inverted duty mechanism. Also, in the apparel side, GST rates are triggered at 5 and 12% depending on the sale price. If it is greater than 1,000, sale price is greater than 1,000, then it comes to 12%, otherwise it's 5%. But majority of the services accounts for the inverted duty structure, which also triggered by the fixed cost. If we also discussed the stores, retail industries also having a lot of stores having existence in pan-India states. The fixed cost, which is majority of rent, manpower, CAM, accounts for accumulation irrespective of the sales turnover. So that is a fixed cost involved in each of the stores which is owned and operated by the company. But sales are subdued and restricted to 5% or on average of 9% on the apparel side. So this leads to a situation wherein we are already facing a huge lot of accumulation, which cannot be controlled because it majority includes for the services and it's a fixed cost to each of the retailers. So we can advise or take support of RAI and other consultants to represent this with the government again so that whatsoever services restricted to textile or apparel or footwear sector can be rationalized from 18% to let's say 12% GST rate. And government is also trying in the past various GST meetings, but somehow this topic of rationalizing the GST rates never come up.
Yeah, very well put up, Manish bhai. So basically the point or the good news, I mean, we have been only discussing pain points till now, but the silver lining is that the government is listening. Okay, let's give them that due credit. You can see the recent circulars which came in the month of July. A lot of circulars came in wherein it was a result of active representation which was done by trade and industry on various aspects, practical issues and the challenges that are there for industries. So there is a hope. I mean, the problem is a real problem. It's a problem for all companies who are paying GST at a lower rate on their final product, but on the input side incurring GST at 18%. So it gets accumulated. And as we go along one year after the other, the credit accumulation keeps increasing, right? And there is added pressure from auditors also that what are you going to do about this credit? Are you going to, will you be in a position to utilize it, or will you be, I mean, do you need to create a provision? So all those issues, the pressure starts building up. And it's high time that there should be some solution to this problem. But I think with active representation, dialogue with the government, and we should use the platform of RAI, I mean, to think about these aspects and go actively to the government with a problem and also with a possible solution or 2-3 alternatives. Yeah, so that was really the second main issue which I wanted to discuss. I'll move on to a very unique industry, which is gems and jewelry. And I invite Kiran with the next question. So I was chatting with Kiran before this session, and he was sharing certain very, very unique situations which are there in the jewelry industry. I mean, to name a few, one is the margin scheme which is there for wherein the customer comes to the company saying, I have old gold, you convert it, and then you sell it to me after conversion, right? So there is purchase of old gold and sale of the jewelry after making, right? And there is a rule in the GST law which talks about second-hand goods where certain amount of value addition or is done, wherein there is a possibility of paying GST only on the margin. Because imagine if you are a customer, you have gold of let's say 10 lakh rupees, you go to a jeweler saying, use this gold, melt it and make new jewelry for me, and I will pay you the difference, right? Let's say the making charges are 5 lakhs, so you pay him 5 lakhs, because 10 lakhs is the jewelry which you have already given to him. But if the jeweler charges you GST on the entire 15 lakhs, right? That's what we are talking about. So it becomes an additional cost for the consumer, and it's a B2C industry. That is one aspect. The second issue is that in the jewelry sector, they have to buy motor cars, which is basically very, very unique, because given the kind of products they are dealing in, they are precious, and the kind of customers and clientele they are working with, they need to have certain motor cars at every store. And input tax credit, as we all know, GST credit on motor cars, vehicles is not allowed. Okay, that is another. The third is e-way bill. I mean, because if you look at jewelry sector, it is not where you put in gold. I mean, I'll quote on a lighter side, quote the example of wherein idhar se aloo jayega, udhar se sona aayega, but it's not that simple, right? If you look at the gold or jewelry sector, there is gold, then gets converted, then it is sent to a job worker, then it is sent for hallmarking, testing, everything. So it changes hands, and every stage there is a value addition. So how do you tackle with the e-way bill issue? Every time when there is a movement, do you generate a e-way bill? So those were some of the issues, and Kiran, if you can shed some light on those and share your perspective on that.
Yeah, thanks for having me here. So, gem and jewelry space has some unique features compared to the rest of retail industry that is there. Though we discussed these challenges are also there in terms of input credits that we take on capex. There is a lot of gray area there and all of those things. But the way gem and jewelry sector is structured is slightly different and unique. The way the supply chain functions, like you mentioned just now, is basically it has got a series of events that happens through the supply chain, and at each activity, maybe it is a manufacture, maybe it is grading or certification of diamonds, maybe it is hallmarking and all of those things. There is a huge amount of movement of goods that happens, and at every level there is a value addition that happens to the jewelry. So if we look at this and the way we deal with also subcontract manufacturing and all of that, in that space, what actually happens is we deal with a lot of unorganized sector subcontractors that are there. So in this case, what happens is one is the e-way bill. So fortunately, the e-way bill is still not being notified by the state governments, though it is notified at the GST Council. But if it comes into play, it is a mammoth task for jewelers, and it is very difficult to deal with e-way bills, despite of having invoicing in place, and despite of having all that delivery challans and interstate reconciliation of turnover, all of that. I don't think it is necessary to have a e-way bill system for this one. The second thing that comes into this is basically the input credit reconciliation that happens with, again, the unorganized sector who charges GST. The input credit reconciliation is another mammoth task when the value addition happens from their side. That is another thing that actually is a task for us. And thirdly, there is a reporting requirement when the movement of goods happens to the authorities in terms of subcontractor. The number of times I issue goods to the subcontractor and take it back, all of that needs to be reported, and that is another, hassle which is there currently. And these 2-3 things are very, very peculiar to the gem and jewelry space. Apart from, there's one major issue which is at a litigation level for us, is the wastage. In other industries, wastage claim is basically a actual wastage, and in that space, what happens is the input credit of the wastage, which is abnormal in nature, is disallowed. But in our case, it is quite different. When the wastage is incurred by us in the process of manufacturing of jewelry, we also charge it to the customer separately as a line item in the invoice. So there is no reason why the wastage should be disallowed. And then there are a lot of clarifications also came from the department. Still, it is a litigative subject for us in a lot of ways. actually. And that goes on. I'm dealing it from 2017 onwards. Every year we have these issues, and this happens. And then apart from that, these cars are something that being in a luxury space, it is important for us to have cars for each of the store that we have. And the input credit of 28%, losing 28% is a big money in terms of that. And apart from that, all the other credits that are in gray area in terms of capex, in terms of construction and making furniture and fixtures for the stores, those are also challenge. And one bigger challenge which actually we lose an edge on is the margin scheme, the marginal tax that we have to charge. There is a loosely held law that is there, which we were discussing today, law that is there which says only on the value addition part you charge a tax. But when it comes to real implementation and when we deal with there are advanced rulings that are there. There is a Karnataka advanced ruling that is there. There is a Kerala advanced ruling that is there, which both of them are contradictory, though the facts are slightly varying. But by and large, if we see, if that is allowed, actually, and the clarification comes, that actually is a very good for the sector, especially the organized sector that we deal in. So these are the broadly,
So these are some genuine issues of the gems and jewelry, and which takes me to the next panelist, Vivek. And here, Vivek, your inputs will be very valuable because with your experience on litigation and with the recent amendments coming in GST, some of them are practically difficult to implement. One of the most recent is on this circular which came on GST credit notes, wherein now they have said that you have to, if you are issuing a GST credit note for a discount, which is post-sale discount, you are mandated to obtain a CA certificate from your customer, confirming that he has reversed his input tax credit. So only if you get that certificate will you get a GST deduction for credit notes. And somewhere this was not conceived in the original GST law. It is not a part of the act or rules, but this has been brought in by way of a circular. So and it's very practically difficult to implement, because imagine you have 1,000 customers. Will you be in a position to obtain CA certificate from all 1,000 of them? Even if you are able to obtain for 80%, 20% will be where you will not get the GST benefit. So you will end up paying that GST at the time of assessment. So this will prompt companies not to go for GST credit note, which again is not a very viable option, because then the customer's GST credit starts getting accumulated. So it's a catch-22 situation. So that is one aspect. And second is, of course, coupled with that, Vivek, if I may add one more typical issue is, since Kiran was talking about the wastage, goods written off. This is not just for jewelry, but all companies, that whenever there is goods which are destroyed or written off, the law says that if you are writing off the goods or destroying the goods, you need to reverse your GST credit. But there are ways of handling this, practical ways where companies have done it. They have just sold it at scrap at nominal value to meet the condition that I have not destroyed it, I have sold it and I've paid GST. So then I'm eligible for credit. So how far these kind of arguments or positions are viable, and what was really the intention of the law and what is actually happening at the ground level? So if you can give your views on these two issues, GST credit notes and goods written off and scrapping of those goods.
Thank you, sir. Firstly, I should be grateful to the organization who has invited me and my dear friend, Mr. Arpit Kabra, who has introduced me to this organization. This issue of credit note, I would take few minutes for the basic introduction of this concept, and then we'll come up with the issue. Basically, credit note is issued under the GST law for various reasons. When the taxable value has been charged more in the invoice, when the tax rate has been mentioned with the higher rate, likewise. The post-supply discount is a unique aspect which is generally given after happening of the supply. The issue is whether that particular post-supply discount should bring the effect of reduction of taxation liability. Say I'm selling the goods having value of rupee 100 and I'm giving upfront discount, say 10 rupee. So I should charge GST on 90 rupee. This is a very basic concept. When it is a concept of post-supply discount, which is generally given on meeting the targets, okay, and I believe in every distribution channel, this concept lies, be it cement industry or anything, right? This automobile industry, any industry. So FMCG, in fact. So if a company is giving a target that if you sell that much of quantity in that particular period, you will be given that much of discount. So the terms are generally agreed upon before making the supply by the manufacturer to the distributor and so on. So the question arises that whether that particular post-supply discount which is being given afterwards should bring the effect of reduction in the output tax liability. So manufacturer के यहाँ क्या tax liability का effect reduction के तौर पर आएगा? So 100 रुपये से मान लीजिए कि मैंने being a manufacturer, I have given a target to my distributor that you sell, say, 1 lakh quantity of that particular product, and in that particular period you sell that much, तो आपको post supply discount दिया जाएगा. अब when the post supply discount is given by the supplier, क्या इसके लिए हम credit note issue कर सकते हैं? This is the first aspect. So law provides 3 cumulative conditions, and satisfaction of these 3 conditions to determine whether this will bring into the reduction of the tax liability at the end of the supply, wherein one important condition is that the recipient should reverse that much of ITC at their end. Now the supplier, how supplier could know about this particular scenario that the recipient is reversing the same or not? Under the GST law, what is happening is when I supply something, I need to declare that particular invoice in GSTR 1, resultantly which is reflected in GSTR 2A and 2B of the recipient. और जब मैं credit note issue करता हूँ, again I do the same exercise, I do declare in GSTR 1 और सामने वाले के यहाँ 2A और 2B में वो दिखता है. The point is कि जब मैं GSTR 1 और GSTR 3 भी फाइल करता हूँ तो मेरे यहाँ आउटपुट टैक्स लाइबिलिटी का रिडक्शन होता है. गवर्नमेंट हैज़ एन कि क्या सामने वाला का ITC रिवर्स कर रहा है, एंड बेस्ड ऑन दिस पर्टिकुलर एस्पेक्ट CBIC has come up with the circular, and where this circular is expecting the supplier to provide the management certificate of the recipient कि हमने क्रेडिट रिवर्स कर दिया. सप्लायर हैज़ टू प्रोवाइड दिस. तो सप्लायर हैज़ टू अरेंज फ्रॉम द रेसिपिएंट कि आप लिख कर दीजिए कि आपने ITC रिवर्स किया है. एंड इन अ केस वेयर पर सप्लायर पर फाइनेंशियल ईयर द ITC amount pertaining to those credit notes exceeds ₹5 lakh, the management of recipient has to obtain CA or CMA, cost and management accountant certification, कि हाँ इन्होंने उस ITC को रिवर्स कर दिया. This is the basic background. Now, coming with this, that whether it is really valid or tenable in the eyes of the law, right? So ये background समझना जरूरी था. उसके समझे बिना हम उसकी tenability को assess नहीं कर सकते. The very first point is that this circular is asking so many things that you could provide management certificate, you need to provide CA or CMA certification for the same. Let me tell you, in the eyes of the law, when I evaluated, this circular has been issued by exercising the power of section 168 subsection 1 of Central GST Act, which says that the circular can be issued by board, that is CBIC, and which has to be followed by the officer. Surprisingly, when I read the entire circular in that line, which is the bone of contention, section 168(1), which says that the officer has to follow. And they are creating new obligations at the end of the supplier to arrange all these certification, be it management certification or CO CMS certification. So the moot question is, can a circular impose a new obligation at the end of the supplier? Because 168(1) says officer has to follow. When the officer has to follow, why the supplier has to follow? So when we check into the legality, I find a very big deficiency. So बुनियादी तौर पे मुझे लगता है कि the circular is actually not empowered. Okay, so it is not supported by the law. So पहली चीज तो ये. दूसरी चीज इसमें ये भी है, this circular is asking to arrange all the certificates for all of the previous financial year right from very beginning of the GST law. So 17-18 से लेकर आज तक के लिए जितना कुछ भी क्रेडिट नोट आपने इशू किया in the name of post supply discount, the supplier has to arrange it. तो यहाँ से फिर practically situation आती है. What if the recipient has gone away? अगर recipient ने खुद ना अपना registration cancel कर दिया, company strike off हो गई or whatever it is, then how to arrange those certificates? And if I could not arrange this certificate, department is going to impose the tax obligation and of course resultantly interest and penalty liability upon me. So मुझे लगता है कि ये circular आज की तारीख में it is not supported by the law. Furthermore, there are practical difficulties to arrange all these things.
So basically the point coming out is that whatever comes in the circular, we should not just accept it at face value. We should challenge it, look at it whether it is legally tenable, can it be challenged, and if it is an issue which is hurting the industry or practically very difficult to implement, then either as a company or as an association, I mean, there can be legal options explored, like filing a writ petition, or again going to the government that this is not legally tenable. Okay, like this example of CA certificate.
Yes. So actually, what is happening is this circular is bringing new obligations, right? And law says for the uniform implementation of this law act, the circular may be issued by the board, right? And which has to be followed by the officers. अभी यहाँ ऑफिसर को जो प्रोसेस फॉलो करना है उसके लिए वो सर्कुलर ला सकते हैं, ना कि टैक्स पेयर को एक नया डॉक्यूमेंट अरेंज करने के लिए सर्कुलर इशू किया जा सकता है. सो आई थिंक दिस पॉइंट मे बी एक्चुअली यूज्ड व्हाइल इन द लिटिगेशन, राइट? यस.
Thanks a lot, Vivek.
Thank you.
Since we were on the point of this post-supply discount, my next question to Jayesh is that this is more on the purchase side. When we purchase or a retail company purchases goods, okay, the vendor may be charging you a certain higher price to start with, and then subsequently they pass on all the discounts to us when we meet certain targets or when certain sales happen, or could be different criteria for that. And in some cases, the vendor issues us a GST credit note. Some cases they don't issue us a GST credit note, they issue us a financial credit note. What is the impact of a financial credit note? What happens is that I have, let's say, purchased something at 100. I have paid GST on that. Eventually, I'm selling it at, let's say, 70 because there is a scheme running. I'm giving some promotion scheme for apparels or any product. Then my output tax will be lower than input tax. So again, it results into input credit accumulation, right? So just wanted to ask you and share your experience on this, how it has been happening in the industry, and what is the take on this?
Regarding the post-sale discounts, what we had discussed, Vivek earlier discussed, I just go one step ahead. Not only the 100 rupees. If suppose I purchase, because we are in the apparel industry, there are two different tax rates. The value change, tax rate change based on the values. If I purchase it at 1,200 rupees, 12% is levied because of more than 1,000 rupees. 12%. If I sold at 800 rupees, not only value reductions, tax reduction also reduced to a 5%. So even if I issue a credit note of 400 rupees, I have to issue a credit note with the GST of 12%. But still, my 800 is paid at 12%, and I am now required to pay output at 5%. So there is a huge accumulations happening in the, if there is a garment industry, if you are selling, and because there are most of the people, you do a MRP, and then there is a huge discounting in the EOSS, etc., etc. So in this case, many times we discuss with the brands, etc., and discuss there is an average you do a discounting of so much. So instead of doing all these hassles, let's discount at the initial billing stage only. So when we are buying product from the brands, they do a discounting at initial billing only, so that this credit note of issuing certificate by the CA, etc., all these hassle will be gone, because the billing discount is being inbuilt in the first stage only, and all the rectification happens subsequently. But what happens, there are certain cases, if there is a, if suppose you have not done this like this, and if you still give a discounts, but there is no obligation by the buyers. And I'm a buyer, so there is no obligation, and the vendor is giving a discount. In this case, definitely you can either you can do a financial credit, or either you can, if there is a contract, say they are required to give a discounts, and I have to pass on the discount to the customer, etc., then either financial credit note or either GST input reversal credit notes can be issued. But in case when there is a buyer obligations, like if you are required to advertise, you are required to do exhibition, etc. So in this case, the discount, beside the credit note, whatever, forget about the credit notes, you have to, because you are providing a service to the vendor. So in this case, you have to raise a service invoice. So 18%. So that kind of things happening in a retail industries.
Yeah, so another angle to this is that wherever we are providing a service to the vendor, rather than discount, we can even explore the option of having a service arrangement. The benefit of this is that we will raise an invoice on the vendor, on my supplier, with GST as a service. That will help me utilize my GST credit balance also, but of course it has to be backed up by genuine underlying service which has been provided. It can't be just saying that I'm providing some service when there is no service at all provided. Thanks, Jayesh, for this, sharing this thing. My next question to Manish, and this is an interesting one. This is on the recent flurry of GST notices, summons, audits, DGGI notices, which has been coming in. There was a recent article which we were discussing before the session that I mean, I don't remember the amount, but I think it was some 80,000.
80,000 crores.
Yeah, 80,000 crores worth notices have been issued in the last few months. Okay, and it will be very interesting to see how much of this will get converted into actual demands. Okay, and 80,000 crore is a huge number. And this is last couple of months, if I may talk about it, the value of the demand notices that have come in. Secondly, the point is that there are some time barring, right? Some assessments are getting time barred. 18-19 is now gone. 17-18 is gone. So department can't come back to us on any demand for those 2 years. But for 18-19, the last date for issuing a notice under section 74, which is the section for alleging fraud, suppression, misstatement, they have even invoked section 74, wherein the department did not issue us a notice in time when they were supposed to issue, but they have issued it a notice now under section 74, and then they are even levying 100% penalty and everything. So, I mean, you can share your experience on that, and yeah.
Yeah, thanks. See, every manufacturer, service providers are flooded with the plethora of these kind of notices. And as late for 18-19, 5th of August is the last date to issue a notice. And by 25th of Feb 2025, they have to conclude the audits. And on the last day itself, or even a prior week ending 5th of August 2024, Department issued a lot many notices under section 74 without realizing the fact that will cover under 73, because 73 time limit has already been gone. And now they have invoked section 74, which is misrepresentation or fraud. But yes, department is estimating 10, 20, whatsoever may be the amount of deficiencies they have notified, they can come up with some amount of funds to the government treasury. But it will create a lot of hassles to the genuine taxpayers who have legitimately availed all the input tax credits or have filed their returns accurately and deposited the tax as per their business trade practices. But yes, it will create a lot of hassles to every manufacturer, service provider, and have to be adequately dealt with the department within a specified time frame. And assessee have again time for next 6 months to conclude those audits in the legitimate ways. But yes, of course, any such demands will again lead to imposition of hefty penalties, interest, and the differential taxes.
Thanks, Manish. In the interest of time, I'll just take the last question, and this one is slightly different from the topic of GST, but again very relevant for all of us. So this is for Kaushal. I'm not sure whether all of you may have noticed, but in this budget itself, it was not in the speech of the finance minister, but in the fine print, it came out that they have announced a scheme, a PLI scheme for certain industries like footwear and leather articles, and they have allocated a budget of around 2,600 crores for the footwear and leather companies. So there is an intention to give certain incentives for manufacturers to set up manufacturing facilities. And similarly, different states are also coming up with new policies, and they have giving GST reimbursement, stamp duty exemption, capital subsidies, so on and so forth. So as a business owner or as a CFO, do you think the government is doing enough on incentivizing the industry on Make in India or incentivizing capex investments in the country? And what better can be done to help the trade and industry?
I would say obviously this is a very welcome step. Just a data fact, India is the second largest producer of footwear, but we hardly export like 5% of whatever we produce. And imports are significant. So obviously, PLI scheme is a very welcome step. It will help over a period of time industry to sort of become competitive and have world-class production facility within India. Over a period of time, this is going to be a big step in boosting our exports. Over a period of time, reduce imports. And obviously, if you have local manufacturing from a business point of view, it sort of helps you to reduce your TAT and your time in getting the products. So, over a longer period of time, improvement in working capital. So I think it's a welcome step. It's still early stages to say, what best they need to do. But I think if intentions are right, I think this will go a long way for footwear production ecosystem as a whole.
On that note, I will call it out for today. As far as today's GST session is concerned, I hope you found it fruitful, and I thank all the panelists for sharing your valuable, extremely precious inputs on live experiences, what is happening on the ground. And the takeaway for all of us is two things. One is when we look at GST aspects, what are the pitfalls or what are the planning areas? And second is what are the points we should take to the government as advocacy, representation point. This is food for thought. There will be more points, more suggestions, and we should engage more through platforms like RAI to come up with those industry pain points and use it as a platform to approach the government for better things. Thank you. Thanks a lot.